Hey everyone, this is Robert Keens with goldsilverpros.com. It is Thursday, December 3rd, 2020, and we're going to talk a little bit about what's been happening in gold and silver this week. We're going to cover the deliveries because we expected December to be a big month, and so far it actually has been on the physical delivery standpoint in both gold and silver, so we definitely have not disappointed there. We're going to show you where the latest data shows that 1/3 of all open interest in the December contract has been delivered in both gold and silver, or around actually about 30%. So very, very strong delivery numbers considering the open interest for the month. And then I'm going to get into something I've wanted to talk about on this channel for quite a while, and that's risk management. And the idea around risk management is managing the risk in your financial portfolio given the world that we live in. Certainly 2020 has seen a lot of changes this year, and some of the risks that we may not have considered to be risks prior to this year now all of a sudden have become risks. And how do we mitigate those risks and deal with those risks as we go forward? I've got a neat tool on my website to help you do that in terms of looking at your precious metals portfolio in light of these additional risks that I wanted to highlight and do a quick walkthrough and a quick example with you. I think that'd be very beneficial. But before we do that, let's go ahead and get started on looking at where the metals are. So as of right now, gold is trading at 1840.91 and silver at 2406. They both have had a little bit of a bump today. Gold a little bit more than silver, but they're both in the green for another day, which is really good. We saw a little bit of a rebound, and I think potentially for December, these could range trade a little bit. One very positive thing is that gold popped above its 200-day moving average here, as you can see on this red line. Now on declining volume the last 3 days, but it has jumped above. Will it challenge the 50-day? I don't think it's going to challenge it anytime really soon because we've got some declining volume in the paper futures trade. So somebody big would have to come in and bid up the price of gold via the futures papers trades to get it to test this 50-day moving average at about, looks like 1883.67 is what it's at right now. That could happen this week. More than likely it'd be something that would happen next week. Over the next 2 weeks, possibly for gold, but definitely positive momentum over the last few days. Good news, as I talked about in Tuesday's video, good news for the stocks and good news for the metals. Taking a look at the volume real quick, like I said, we've had some declining volume, but the good news is if you look at the December contract, we've had 4,238 deliveries out of 15,718 open interest. Actually, it's about a little over a quarter of the open interest were delivered for a Wednesday, December 2nd data available on the CME Group's website. So still very strong for gold, good deliveries per the open interest. We're up to almost 400,000 contracts in February. And if you look at the settlements, it looks like that's what's pulling the price up because the February contract was trading at about 1841. And again, we're sitting at 1840. So that's what's driving the price is this February trade at 1841 is pulling that gold price up. So that's pretty good news. Now, again, on relatively weak volume, but at least we're seeing the price come up, and we'll see if it challenges, if gold comes back up to re-challenge its 50-day moving average. It challenged it once and came down and kind of stayed there in the doldrums for a while. It looks like it's got some upward momentum. We'll see if it passes that on the chart. That's just a technical barrier. Of course, if we get a bit of news that would be positive for gold, you could see it shoot right past that 50-day moving average. We'll track that definitely as it comes. Now we're moving on to silver. This is the silver 3-month chart, and you can see since November it popped through its 50-day moving average as represented by the squiggly blue line, but came back down in the November 9th slaughter, which I showed you right after November 9th occurred. And we got the data. I showed you how there was a big, massive paper smash. It came back up to challenge it on the 16th and then stayed down for a while, and it's challenging it again. So it looks like it's challenging this 50-day moving average for a third time. If it pops through and stays there in December, then that means we're probably in the next leg of the silver bull market, and it'll go back up and challenge at 2450 mark, which is just slightly above its 50-day moving average. And then it'll go up and challenge the 30-day mark after that. So we'll see what happens, but definitely positive news in both gold and silver on the chart. Again, you can see a little bit of declining volume on the move up. So it's not a really big move up, but it is a move up. And if we look at the overall deliveries, 998 out of 3,337. So maybe about 30% or 29, 31% of open interest in December is being delivered, which again is strong. We said for the last few months, we expected December to be a strong delivery month, and it has. And we're also seeing prices rise because again, when you have either 25 to 30% in gold and silver of all the open interest being delivered. That tends to have a positive effect on price because it means the overall market is positive towards the metals, and that's why we're seeing the prices come up. Going back to the month to date delivery notices, I wanted to show you what's going on in gold and silver so far for December. So December so far, we've had 14,191 cumulative contracts stand for delivery in the gold futures, which is a very positive sign. We're only 4 delivery notice days into December, starting with 11/27/2020, which is the first intent date for December, as you can see here on the chart. And we've already got 14,191. In fact, the first 3 days are really good. We have 5,300, 45.60, and 42.38. Now, that is declining, but 14,000 contracts in the first 4 days is very, very positive, especially considering since most of the open interest is now trading in a future contract month. Again, it is having a positive effect on the price. We can see that over the last few days. Now let's look at silver, the 4 days. We started off 1169. When this 1169 contract stood for delivery on the first day, which was Friday, 11/27, people were really disappointed. I saw a lot of negativity on Twitter. A couple of my friends who are in the precious metal space were like, oh, I'm really, really disappointed. But look what happened here. It picked up the next day on the 30th on Monday with 3,599 contracts, and we had 998. And then just yesterday with 1829. So we're up to 7,500 contracts of 5,000 ounce silver standing for delivery. So again, not horrible numbers. So I really don't think people should be disappointed with the delivery so far in December. I don't think they've disappointed, as has been pointed out by several precious metals analysts this year. And along with myself as one of them, we've had really high deliveries in the precious metals this year. 2020 has been a massive delivery year overall for the precious metals on COMEX, dwarfing previous years. I mean, literally dwarfing previous years. And you can see it in the amount of metal that's sitting in the COMEX warehouses in the eligible category. After people take delivery, they're just parking it ineligible. And I've showed that Nick Lear's chart before. I guess maybe I'll show it next time. But we've seen those stocks go up and up and up into 2020. And there is a record amount of gold and silver sitting on the repository. Most of it's not for futures delivery. Most of it's in private hands as storage. But again, we're continuing to see those deliveries. So keep in mind the big picture here. People that are wealthy and wealthy individuals and corporations are taking a lot of gold and silver delivery because they're bullish on gold and silver. So don't worry too much about short-term price changes. Look at the physical movement, and the physical movement in 2020 has been as strong as I've ever seen it on the COMEX. And that is a positive sign. The next thing that we want to talk about is risk management. Like I said, should you be taking delivery of gold and silver, and how much should you be taking delivery of to protect your own portfolio? Let's say you have a house and a bank account and some land and maybe some cars and some other things that you want to protect. Gold can be your biggest insurance policy. And if we really get to tough times, silver can act as money, borrowable money. And so I've developed basically a free precious metals planner you can get to on my site. You just go to goldsilverpros.com. You go over here to education, you click on financial education. We'll do that now. And it takes you to the financial education landing page. Here you can get some free educational videos. But what we want to do is go down here to the Precious Metals Planner. By the way, right next to the Precious Metals Planner, if you haven't read it yet, is a free copy of my book that I wrote in 2009 and published in 2010. It's a great way to see what I was writing about in 2010 and did what I say come true. Good way to see if I have good prognostication abilities. And I think I do. I think you'll be impressed by a lot of things we talked about 10 years ago and where we are now. Anyway, getting back to the free precious metals planner, how much gold and silver do you need? Well, that's a very individual decision. I actually had a consultation call with a member about a week and a half ago, and she wanted to know, Rob, I've seen a lot of additional risk in this environment. What do I do in this environment? How should I be managing my portfolio? Well, I didn't really want to be a financial planner, but I did want to be an information resource for her. So I said, hey, let's sit down and talk about your individual situation. And one of the things I pointed her to was it really depends on your individual situation. It's different for everyone. It depends on your lifestyle. It depends on how much insurance you need to protect your existing assets. It depends on how much, metal you'll need as potentially a cash replacement if we have issues with the dollar. It depends on a lot of factors. But one little tool you can use, I told her, was go to this precious metals planner, and it will help you with that. And the precious metals planner not only tells you maybe how much precious metals you need, but also looks at your overall cash flow and your overall asset base and kind of tells you, are you on the right track financially speaking? And this is back in the days when I had passed some financial licenses and had learned basically how to do some basic financial planning with people. I built that right into this calculator. So we're going to run through and do a quick example I'm going to read the disclaimer here. These calculators are included to help you with planning a potential precious metals portfolio. Everyone investing in gold and silver should use a planner to determine how much they will actually need. And again, it's an individual decision. Please copy the results down when you're done. They're not stored on the site. Again, this is stored in your browser, so I will never see this information. It's not stored on any server that we have on our website. Note the references gold and silver in site refer to physical. So we're not talking about ETF investments. We're not talking about stocks. We're talking specifically gold and silver coins and bars, bullion, basically. Not talking about numismatics, although I think numismatics can be a part of your portfolio. This is just bullion. So it's a bullion calculator. And we start off by the net worth estimator. Why do we do that? Because the net worth estimator is going to tell you, one, are you positive net worth or negative net worth? Do you have more debt or do you have more assets? If you're in a negative net worth situation where you have more debt than assets, it may actually be more beneficial for you to spend most of your free cash every month attacking that debt. Start with a high interest rate debt and move your way down to reduce your overall interest payments or liability payments to other parties before you start investing very heavily in precious metals. So that's something we actually talk about in the planner. If you have much more assets than liabilities and you have a high net worth, and that may be where you want to start moving some of your money into the metals to help protect that net worth and also to capture that gain that the precious metals have been having, because the precious metals since 2000 have been beating the stock and bond markets pretty handily, and they're still in their bull market. So you can use precious metals as a way to gain return in your portfolio, but mostly it's as insurance in case other things happen in your portfolio that either damage or take away some of your other assets. Or let's say you lose your job and you have a house payment. How do you insure against that? Well, one good way is to have some free cash for about 6 months to a year, but another way is to have precious metals because they're going to go up in value over time, whereas that cash is going to depreciate. And you can turn that precious metals into cash when you need it to make your mortgage payments or your credit card payments or your car payments or whatever the case may be. So anyway, without further ado, we're going to run through an example. And I'm going to use numbers that are pretty close to what the average American has. Of course, your situation will be different, but we're going to do that just to kind of keep things simple and at the average. You, of course, can go to the website and run your own calculation in your own free time. We start with the residence market value. That's what you could sell the house for. So we're going to say the average is about $250,000. Minus amount of mortgage and other debts. Most people owe 75-ish to 80% of the debt. To make it easy, we're just going to put 200,000. Vacation or second home. The average person does not have a vacation or second home. So I'm going to put a 0 here and I'm going to put a 0 for the debt. But if you have another asset, and it can either be a home or it could be any other asset that you have that either has a value and also may have a liability attached to it, you can put it here. It doesn't really matter if it's a home or not. Other investment, real estate market value, most people don't, but they may have something else of value. So we're just going to put 10,000 there. Minus amount of mortgage or debt, we're going to put 0. So let's say you have 10,000 other assets that you want to protect. Furnishings value. This is things like paintings and furniture and things that may have value. What I do is when I calculate this is a real asset because you can garage sell these, you can eBay these, you can do a lot of, you can Craigslist things and get some money out of it. Now you may only get 35, 40 cents on the dollar. So what I do is take about 40% of what that value is and put it in here. So I estimate the average person puts $10,000 to $15,000 of value into their home, the average 3-bedroom, 2-bath. So we're going to estimate that it's worth 4,000, or you could put 10,000 if you want. And the minus amount of use, stop being new at the purchase date. So we're going to put $6,000 of use. So that gives you about 40% of value that you're going to be able to get out of, like used furniture and paintings and silverware and vases and TVs, electronics, and that type of thing. Automobile market value, the average cost of a car now is about 30,000. So we're going to put that, and the amount the loans to be paid off, we're going to say is about 20,000. So you got about 10,000 positive net worth in your automotive vehicle. Art, jewelry, and other liquid valuables market value. Now, the average person doesn't have a lot of expensive art. They may have a few $100, $200 paintings, but they're generally going to have jewelry and things of other liquid value. Now, it may be 10 karat jewelry or 14 karat jewelry, but it's going to have some metal value. So we're just going to put $10,000 there. Cash in the bank, the average person actually only has about 4 months of the study at CNBC earlier this year, late last year, was something like the average person has less than 4 months of income and they make about $65,000 a year. So let's calculate what that would be. So that's $60,000 a year divided by 12 months. We're going to multiply by 3. We're going to say they have less than 4 months. So we're going to say they have maybe 15,000 cash. I actually think it's less than that, but we're going to be generous. and put $15,000 cash. Now, gold bullion and coins you already have. The average person doesn't have any, but we're going to put a number here anyway, just to put something there. So we're going to say $2,000 of gold, and we're going to say $500 of silver. Liquid investment accounts, stocks, bonds, etc. Now, this is liquid. This is stuff you can actually get to, whether it's some sort of pension or 401k fund, which you can take a loan on, or a life insurance policy. You know, cash value life insurance down here. So maybe cash value life insurance is $15,000. You have some sort of whole life. Liquid investment accounts that you can actually take a loan in terms of hardship. Well, you know, I'm actually going to say $50,000. Long-term, well, actually 50,000 under long-term retirement accounts, and other liquid investments will just put 3,000. The total assets about 174,000. Now, the average person may have some student loan liability. I'm averaging in the different generations. The millennials have 92 million people. The baby boomers have 77. So I'm going to say the average person actually has a positive student loan balance. Gen Xers like myself have usually paid it off. So we're going to assume that the average person is going to incur $60,000 of student loan debt and be conservative. They're going to a state school, but that only about 40% of people actually have that. So it's going to give us around $24,000 average for an American in student loan liability. Interest owed on any real estate that you're not planning to sell, we'll put 0 there for now. Credit card debt, the average is something like $12,000. Any other debt balances plus interest costs of life of the loan, we're going to say if there's some other loans involved, revolving credit at about $5,000. So total liabilities there is about 41,000. So your net worth is actually a positive 133. That's what you can tap into your house, your insurance policies, takes loans against, sell your furniture, things like that. Your liquid worth about 133,000. Now, I think I was actually slightly generous here in 133,000. I think the average person's probably not there, but I wanted to have a little bit of positive net worth for purposes of the calculator. I actually believe if you took the average lower middle class person, they would not have a lot of positive net value. They would have some value tied to the residence. They would have some value in some other things like jewelry and furniture, but they're probably actually going to have more liabilities than that. And they're not going to have as much equity as I gave credit for on their house, because most people switch their house every 7 years and they upgrade. So they take on more debt. So they're usually a lot less than 20% equity. So I was a little generous, but for purposes of this, we're just going to keep it this way. The next step on this calculator is the available income calculator. Now, before we go there, I'm going to read this important note I have at the end of the net worth. It says, and let me blow this up a little bit because it's really, really hard to read. If your net worth is negative, it may be a good idea to pay down debt by liquidating some of your assets. You will have to decide whether it's better to invest your income in gold and silver as insurance or aggressively pay off debt as fast as you can before the economic collapse scenario plays out. If you decide to pay down debt, most financial types advise paying down variable rate debt like credit cards, highest rates first. That will be your biggest risk when collapse happens because the variable rate debts will skyrocket, eat up any cash you may have. There's a couple important things here. If you have a negative net worth, you probably want to pay down debt before making any investment type, stocks, bonds, real estate, gold, silver, whatever the case may be. That's just good practice, especially if you have high interest rate revolving debt, because that high rate revolving debt is the biggest threat to your growth of your income and growth of your overall wealth. And especially in times when interest rates rise. If we have a banking system failure situation, that 20% could go to 30% or even higher. And that could rise, and it could be that you're only able to make your interest payments and not pay your principal, or you're not even able to make your interest payments. A lot of credit card companies now have policies in which you don't even have to make your full interest rate payment, and whatever you don't make in your interest rate, they just add back to the loan, and it literally, your loan balance grows exponentially over time. So you want to attack the credit cards first generally, especially have negative net income. But because in this example, we're saying positive net income, we're going to move forward with the precious metals investment. So here's your available income calculator. This is your monthly cash flow. This is your monthly cash flow statement. How much do you make and how much do you spend and how much do you have free that's not going to some other liability that you could invest in some asset like precious metals. So total wages, business income, other monthly income. I think it was $5,000 a month. The average $60,000 salary for the average person in America. Total monthly expenditures, which includes loan, recurring payments, miscellaneous other payments. Tip, take the rolling average of the last 12 months, like look at your checkbook account, your credit cards, add all that together for the last 12 months, take an average, and then I add 5% to count for next year's inflation. Inflation is probably closer to 10% now, but when I wrote the calculator, it was probably really closer to 5 to 6. but we're just going to use the 5% here. So I'm going to say if you make 5,000, you're probably spending 4,400 on your liabilities, and you're probably able to spend, sorry, 4,400, not 44,000. Your monthly discretionary income there is therefore 600. It automatically calculates this for you, and it calculates a percentage. A percentage of income available for investment every month is 12%. That's actually not bad. Most people are less than that. I'm being a little generous here. Most people are probably 5 to 6% that they could save into some asset like precious metals. But I'm going to be a little bit generous here to give us some wiggle room on this calculator. Important note, if the discretionary income above is less than $250 a month, and we're slightly above at 600, and also the percentage is less than 10%, we're at 12%, so we're pretty healthy. We have some pretty healthy free cash flow every month from our job or our business. Please consider paying down debt before spending more money. Now, it's important that we put some of these guideposts in here for you, because we don't want you going out and buying precious metals if you don't have the free income to do it. And we don't want you buying precious metals if you have high interest rate credit cards, or you have too much debt and have a negative net worth. That's not a good situation in general. Every person's situation is different in terms of their own financial portfolio, but certain rules are pretty standard and apply. Most financial advisors will advise you, if you have no free cash flow, you got to pay off debt and get rid of some of that debt and get some free cash flow before you start buying assets. Because if you buy an asset, but then you end up having to pay off a debt, you may have to sell that asset you just bought at a lower price than you bought it, or at the same price you bought it minus transaction costs, to go pay off this debt. So you want to pay off some debt first with your free cash flow, or get rid of some things, sell some things like that vacation home, or that extra jewelry you don't need, or, that TV that you didn't need, you can sell off, get some free cash. So you can pay down some debt, and then you can get your revolving debt balances down. So you have some free monthly cash flow, and then you can invest in precious metals. So I wanted to point that out here. Those are some traditional financial axioms that I think are pretty strong and positive that we should be paying attention to. And this will apply to a lot of you out there, which are average middle class and may have a lot of debt, or may not have a lot of free extra cash flow every month. You want to think about those things. What you want to do is attack debt first. If you have a lot of debt as a percentage, or your overall just numerical balance, you want to pay a lot of that down and free up some cash flow, and then go buy your precious metal, because you're more than likely to be able to keep it over the long run. Last section of the calculator is a precious metal simulator, the part that we've all been waiting for. And this estimator will examine your liabilities plus next year's expenditures and determine the amount of precious metals needed as insurance. It takes into account any precious metals you now have in your possession. So your total liabilities plus 1 year's worth of expenditures, meaning what you spend every month for 1 year, for this example, is $93,800. Okay, so you have to insure $93,800. Now, your liabilities is what you're going to insure with gold, and next year's expenditure is what you're going to insure with silver. So we're looking at silver as the poor man's gold. It's the spendable precious metals, whereas the gold is more insurance against the big things that you want to insure, the ability to be able to pay off your house, the ability to pay off your car, those big things that you need. That's what gold's good for, where silver is more of the spendable cash. You take 25 ounces, go sell it at your local dealer and have cash for the month. So cash value. This is the cash value of your insurance plan to protect your wealth and pay off your liabilities. The number may shock you, but there's good news, because during economic crisis, gold and silver prices rise. You don't have to save all of this cash for economic emergencies. The numbers are provided here for your information and for comparison on a precious metals insurance portfolio. So what is the first part of cash value? How much more cash than you have now in your bank account would you need to cover your monthly and long-term liabilities? Where this is above zero, congratulations, you have enough cash to cover your expenses. Most people are not going to be in that situation from a liquidity perspective. Most people are going to be on the second line, where the number is below zero, you have to save more cash to cover them. In this case, $78,800. So you need $78,800 more cash. So then the next calculation is how many more months, given your free monthly cash flow, it would take you to have enough cash to protect yourself in a severe economic crash. This assumes that the dollar maintains its current value, which is very unlikely. So assuming inflation goes away and we just set the dollar equal, it would take, on this portfolio, the average person, 131 more months to be able to have enough cash to survive an economic crash. The average, if we have an economic crash coming sooner than 131 months, this person's in trouble, because they're not going to have enough cash to survive. They're going to have to start selling everything. So it's better to plan now for that now, and start thinking about how you can address that situation now before the economic crash happens. Because one thing that happened during the Great Depression, if you look at videos back then, and certainly both my parents grew up during the Great Depression, they had stories. A lot of people would sell their furniture to pay their monthly bills, but everybody's selling furniture. So the value of anything that you're trying to sell when everybody's trying to do it plummets sometime to 10 to 20 cents on the dollar. So what you want to do is do this ahead of time. You want to free up monthly cash flow ahead of time, pay down some of your debt ahead of time, get your cash and your gold and silver levels up ahead of time, so that when you have the crash, you're not selling your assets for pennies on the dollars, just trying to survive and to eat and to keep a roof over your head. Here's where it gets interesting. Gold and silver protection plan. First, enter how many physical gold and silver ounces you currently have in your possession. Then we will calculate what you need given the different economic scenarios. So I think we had 2,000 in gold and 500 in silver. So silver's trading, what was silver trading at? Say $24. So we had $500 in silver, we said. Further up the survey, $25 each is going to be about 20 silver pieces. So we're going to say we hold 20 silver pieces. So we're accounting in our long-term insurance plan that we have 1 gold ounce, about $2,000 worth relatively, and 20 silver ounces. We've tried to do some saving in gold and silver where we could. And believe me, this is more than the average person has. The average person has none, because we know from statistics that we've seen over and over again, only about 0.5% of people own gold. The average person owns gold, physical gold and silver bullion in this country. So I'm actually being generous here and saying we actually have some. But I put these here because if you actually have started saving in gold and silver, I put a field here that would account for that, and it reduces the average amount that you have to get to. So let's say you're going to have to get to 30 ounces of gold. If you already have 5, well, great. You only need to get 25 more. So that's why it's in the calculator, even though the average person does not have that much. So now is where it gets interesting. Now is the output from all of those fields that we entered, from calculating our net worth to calculating our monthly cash flow to calculating, how much cash we have on hand and what we have to insure with gold and silver. We come to the results, the part that gets the computer spits it out and gives us a result. So scenario 1, current economic conditions. If we never have another economic meltdown during our lifetimes, for which the odds of that happening are pretty much 0, the average person would need 32 ounces of gold at $12.50 an ounce. Now, I want you to notice something. I made some assumptions here because I developed this calculator 2 years ago. So gold was at about $12.50 when I put together this calculator. It tells you how old it is, because now we're at, what was it, 1840 today, and we touched on 2070 earlier this year. So in actuality, it would be less ounces of gold at 1800. But it goes to show you what the debasement of the fiat dollar in just the last 2 years, where we were trading at $12.50 an ounce gold, and now we're at 1840 and we're at 2000. That's the debasement of the dollar over time being shown in the price in dollars of gold. So I'll update this calculator for you, but at 1800 gold, it may be closer to like 25 ounces of gold, but you get the idea. Approximate silver ounces needed at $15 an ounce. Of course, now we're at 24. So it'd be less than 3,500. It'd be something like 2,700. This calculator gives you a really good idea of how much you would have to have. So, and that's in current situation. If you want to ensure the value of your house and your assets and have enough silver to spend in case of an emergency, gold protects your assets. Silver is for spending, is the assumption made on this calculator. You would still need about 30 ounces of gold and 3,000 ounces of silver in the current times, assuming we haven't had a really vicious crash. Now here's scenario 2. This is a short-term Lehman-style crash in debt markets, i.e. 2008 to 2010. Government bailouts work temporarily, and the economy returns to normal after 6 months or so. Somehow the economy limps along its current path for another few years, buying us a little more time. And gold is at $16.50 an ounce, silver at $50 an ounce, which is about what it was at the height of the panic last time. You would still need 24 ounces of gold and 1,000 ounces of silver. Now, given that gold is trading a little bit higher than that and silver is trading less, you would actually need more silver and less gold than shown here, but it gives you an idea. It's in the ballpark. Scenario 3, double-digit inflation, energy prices skyrocket. For example, late 70s, early 80s economic conditions. So if we get into that stagflationary episode, high energy prices, economic conditions not too good, interest rates high, you would need 19 ounces of gold and 439 ounces of silver, because gold would be somewhere $2,100 an ounce and 115 ounce silver. Now look at this price of gold. We almost got to $2,100 an ounce. What does that tell you about the actual prices in the economy? If during the 70s, you it would be 20, and I used financial data from the 70s to calculate this $2,100 an ounce. That's how I got it. I didn't pull it out of the thin air. I looked at 70s inflation rates and things like that, and came with $2,100 an ounce. We almost got to $2,100 an ounce because our inflation is actually higher than what the government reports. So right now, I think we're actually almost in scenario 3. Now, silver hasn't bumped $115 an ounce. A lot of that has to do with futures trades, and that most of the market hasn't realized we're in a silver shortage. Really, only the precious metals commentators have. But it would not surprise me in the next couple of years to see silver at $115 an ounce when those shortages are realized. So that gives you an idea of what would happen in scenario 3. Scenario 4, which I wrote about in my book, which I think eventually will happen, is a complete debt market collapse. That's what I predicted would happen in my book, and very likely, considering there's more debt at all levels now than any time in human history. Please note in this scenario, silver prices skyrocket due to insane investor demand, because one, it's cheaper than gold. It's the poor man's gold. And right now, silver's mostly priced in industrial demand. When you have insane investor demand because people can't afford gold and they flood into silver, silver prices go up. So we're estimating $1,111 silver price, and we're estimating a $10,000 gold price to account for this debt market collapse. And when that collapses, the prices of gold and silver really come up in fiat terms in the dollar system when it collapses. And we're also saying that silver and gold reflect a 9-to-1 ratio. Right now, they're nowhere near 9-to-1, but that would be what happens when the fiat system collapses and gold and silver reach their true potential. You'll see it go closer to a 9-to-1, I'm sorry, or maybe a 15-to-1 that we've seen over the last 100 years. So in that case, you would only need 3 ounces of gold or 24 ounces of silver. So here's the good news. The good news is, if you're the average American and we do have a complete debt market collapse, you would only need 3 to 4 ounces of gold and about 30 ounces of silver. So if you already have that, that tells you just to hold on to it and then just work on paying down your debt and creating more free cash flow. And then when you do that, if you want to invest more in gold and silver, go and do it. So that's the good news. If we just get into a long stagflationary situation like the US in the late 70s or Japan, then you'll need a little bit more. So you may need to invest a little bit more to protect your portfolio and have a year's worth of expenses to pay off your bills so you don't lose your assets. It would be around 20 and 439 and so on and so forth. So a lot of people get stuck at scenario 1. They look at the current scenario and they're like, I got to have 30 ounces of gold and 3,500 ounces of silver at current prices to insure my assets and have enough, to be able to pay bills for a year. Actually, you don't. The good news is when we have the worse the crash is, the less gold and silver you actually need. So the way to look at gold and silver, and the good news in all of this, is you don't need a lot. The whole reason I did the calculator was to prevent people from buying too much, to prevent people from not paying down their debt and stressing so much that you have to buy 1,000 ounces of gold or 10,000 ounces of silver because you're looking at today's prices. Don't worry about today's prices, plan with tomorrow's prices. That's the whole point of the calculator. Put in your financial data, pick the scenario you think is most likely over the next 5 to 10 years, and use those ounces as a guideline for what you need to get to. And then use the rest of your money to, 1, have fun and enjoy life, and 2, pay down your debts. Pay off your high interest rate debt, sell your boat, get rid of your extra televisions, maybe downgrade to a more feasible house. If you're living in a 5-bedroom McMansion, that's worth $800,000 and $750,000 is your mortgage, and you don't have a lot of positive equity, sell that off, and then go buy something cheaper. Make your financial situation a little bit more to your advantage. Those are different ways to handle a situation without having to buy 24 gold ounce bars. And then it also takes the stress away of worrying about the gold price. You don't worry about when the price retraces 10 to 15% and you're not pulling your hair out, because the long-term value of that gold and silver when we get into the eventual last scenario, which is going to be the debt collapse. And the good news is you don't need a lot of gold and silver. The average person does it. Now, if you're very affluent and you have lots of real estate to protect, you may need a lot of gold in order to do that. You may need more. But if you're very affluent and you're afraid of being able to secure that gold, sell off some of your assets and transfer it into gold, you can balance that equation. You can sell some of your assets, which will bring down the amount of gold you have to actually have. And so it balances the scales. Same thing if you're average middle-class person. You can't afford 3 ounces of gold right now, sell something you don't need and buy the gold. And that way you've got the 3 ounces of gold, and that's your crisis insurance. And then if you need to get to that 300 or 400 ounces of silver to have spending cash for a year in a collapse scenario, sell a TV, downgrade something. Stop buying Starbucks every day. Do something like that and start accumulating. But the good news is you don't have to go crazy with accumulating the precious metals. And that's the point of the calculator. And that's risk management. That's talking about different scenarios, different risk scenarios, looking at your personal financial situation, and then providing some sort of template which helps you figure out what your portfolio of precious metals should look like. And I think the results are really surprising and positive when you look at it that way. You're not trying to climb the mountain all of a sudden and buy an entire gold mine and try to speculate and hit the home run, on your gold and silver. So wanted to provide that information to you guys. It's a free resource on the website. I haven't talked about it enough. I also have lots of other educational resources on the website. Make use of those, guys. I mean, on days that I'm not providing videos and you still want to get your fix of precious metals, in economic news, go read the book, use a precious metals planner, go back and look at old editions of the weekly articles, look at the quarterlies that I've printed this year. There is look at the educational videos I have in that free education section. Tons of material there. Go and utilize that. I put it out for reasons to help you guys out and help you advance in your knowledge of the economy and the precious metals, and help you come to peace, because we're dealing with a lot of different risk scenarios now. The risk scenarios have amped up, and that tends to create a lot of stress on people. And the way that you get out of that is you start with your financial plan, and it moves you into action. It gets you out of analysis paralysis. How much do I need? Well, we just answered that question for you. Now you start your savings plan, you start accumulating, and then you have time to go educate yourself and become stronger, and so that you know how to deal with these risk scenarios that keep popping up and keep increasing, as we get further along here. Anyway, this has been a long video, but hopefully it has value to you. Hopefully it's something that you can use. Hopefully it brings you a little bit of peace knowing that you don't have to go buy as much gold as in Fort Knox to protect yourself, that really the situation is not quite that dire. And the revaluation of precious metals that is coming when we eventually get to that debt collapse is going to work in your favor. So don't go crazy worrying about how much you have to get. Secure your gold and silver while you can get it. Pay down your debts, enjoy your life, enjoy your time, and take the stress away. Get on a plan, and that will take your stress away. Okay, till next time, Rob, everybody, this is Rob Keens with goldsilverpros.com.